Disney just raised its buyback target to at least $9 billion, while segment operating income jumped 21%. But the reported GAAP EPS fell 48%. In this video, I'll grade the report, then walk you through how I'd trade it. Nothing here is financial advice. Disney gets graded and traded. So on the headline, revenue actually came in about 0.75% shy of estimates. But the underlying number was up 7% year over year to $25.2 billion, with experiences up 10% and entertainment up 6%. On the EPS line, they reported a headline beat of about 10.75%. But here's the catch. The GAAP number was $1.51, down 48% year over year. The adjusted EPS management actually guides to was $2.06, up 28%. That's the real operational number, and that's what supports the reiterated guidance. So on the beat itself, and remember, we're grading against the adjusted number, not the GAAP optic. This earns a B. Revenue was slightly light, but a plus 28% clean EPS beat, combined with segment operating income up 21%, is a solid print, just not a monster. And on consistency, this earns a B too. Disney has been steadily beating on adjusted numbers, but the revenue side has been closer to inline than a wow, so a B feels right. Let's talk about the positives from the report. Total segment operating income jumped 21% year over year to $5.56 billion, and that was modestly ahead of what management had previously guided. This is the operational number that matters, not the noisy GAAP line. Free cash flow grew 63% year over year to $3.07 billion, and operating cash flow was up 33%. That's the fuel behind the raised buyback, and it tells you the cash generation is real, not just an accounting story. And that ties directly into this one. Management raised the fiscal 2026 buyback target to at least $9 billion. That is a direct signal of confidence, because you don't authorize that much repurchase unless you believe the cash flow trajectory holds up. The segment mix was strong across the board. Experiences was up 10% driven by parks volume, and entertainment segment operating income nearly doubled, up 64% to $1.68 billion. The flywheel is working. And here's the one that really stood out to me. Management reiterated double-digit adjusted EPS growth all the way through fiscal 2027. Disney rarely gives multi-year visibility like that, and it's the single most important signal for anyone holding this for the long haul. So, on profitability, this earns an A. Segment operating income up 21%, free cash flow up 63%, and entertainment operating income up 64%. That's about as clean a profitability picture as you'll see from a company this size. Now, let's talk about the negatives from the report. Sports segment operating income fell 17% year over year to $858 million. That's worse than the 14% decline management had already guided to, and it was hurt by early NBA playoff sweeps and a network carriage dispute. The GAAP EPS number is the noisy one, down 48% to $1.51, versus adjusted EPS of $2.06. That gap points to material below-the-line charges the release didn't itemize in the excerpt, and it's the kind of thing that spooks headline readers even when the underlying business is fine. Management explicitly flagged continued softness at Asia parks going into fiscal Q4, plus international attendance headwinds at the domestic parks. That matters, because experiences carries about a 30% operating margin, so any attendance slip flows straight to profit. On the film side, both Mandalorian and Grogu and the live-action Moana underperformed at the box office. That's a rare admission from Disney that headline theatrical bets didn't clear the internal bar, and it reminds you the film slate is still lumpy. And finally, streaming ad revenue on the subscription video on demand side grew only 3%. Management called out marketplace supply growth, creating a softer demand environment, and that's a structural headwind for streaming monetization going forward. So on guidance, this earns a B. They reiterated fiscal 2026 adjusted EPS growth of around 12%, guided Q4 segment operating income to about $4.9 billion, and reiterated double-digit adjusted EPS growth in fiscal 2027. That's a solid raise and reiterate combination, held back only by the sports and Asia caveats. And on red flags, I'm at a C+. Nothing here is a business-breaking issue, but the sports miss versus their own guide, plus the Asia softness, plus 2 film misfires. That's enough real stuff to keep me from calling this print clean. Putting it all together, this was a clean operational beat wrapped in a messy GAAP optic, the stuff that actually matters. Segment operating income up 21%, free cash flow up 63%, buyback raised to at least $9 billion, and a rare multi-year adjusted EPS visibility statement. All points the right direction. The negatives are real but bounded. Sports missed its own guide, and Asia Park's softness is a stated Q4 headwind. So putting it all together, I'm giving this print a B. So that's my grade on the report. Now let's talk about what you actually do with it. I've broken this into 6 scenarios depending on where you stand. Whether you're looking to get in, selling cash secured puts, holding shares, sitting on covered calls, holding leaps, or underwater, or thinking about adding. Find the one that best fits your situation. Okay, let's get into it. Management stuck with their multi-year growth story here, calling for around 12% adjusted EPS growth in fiscal 2026 and double digits again in fiscal 2027. So I'm not sitting on my hands waiting for a pullback. The bump in the buyback target to $9 billion tells me the company is putting real money behind the stock, and that gives me a floor I can lean on. Rather than chase shares into post-print strength, I'd rather sell cash-secured puts sized around that fourth quarter segment operating income target of $4.9 billion. So my play here is legging in with cash-secured puts. For my cash-secured puts, I'm keeping my floor strike below the pre-earnings trading range because I want a real cushion if the stock cools off. Management specifically called out softness in the Asia parks for the fourth quarter, so I'm respecting that and picking a strike where I'd genuinely be happy taking assignment given that reiterated 12% adjusted EPS growth. I'm only going closer to the money if I'm truly willing to own shares heading into fiscal fourth quarter, because that $4.9 billion operating income target already anchors expectations and caps the upside surprise. So I'm keeping my strikes below the pre-earnings range. If these were my shares, I'm holding them here because segment operating income grew 21% and free cash flow was up 63%, and those are real numbers. On top of that, the raised $9 billion buyback and the reiterated multi-year adjusted EPS path tell me the ownership thesis is intact. The only reasons I'd trim would be if Asia Park's weakness gets worse than what management already flagged for fiscal fourth quarter, or if the sports segment miss keeps repeating. So my move is to just hold the shares. For my covered calls, I'm letting strikes at or above pre-earnings resistance ride because the raised buyback and reiterated fiscal 2027 double-digit adjusted EPS growth back a higher trading range. If shares get called away at strong strikes, I'm fine with that outcome because I'm still capturing the run. But for any call strike sitting well below where the stock is trading now, I'd roll up and out to grab more of that upside from the guidance reiteration. So I'm letting the high strikes run. For my leaps, I'm holding here because management explicitly reiterated double-digit adjusted EPS growth all the way out to fiscal 2027. That kind of multi-year visibility is rare, and it directly supports the 12 to 24-month thesis my long-dated calls are built on. The sports segment softness and the Asia Parks weakness are near-term issues that don't break the experiences, plus streaming margin expansion story underneath. So I'm holding the leaps. The print here validates the original bull thesis for me, with experiences up 10% on both volume and rate, and entertainment segment operating income up 64%. Adjusted EPS came in up 28%, and management raised the buyback while sticking with their fiscal 2026 and 2027 growth targets. Rather than adding shares outright, I'd average down using cash-secured puts, sized around that $4.9 billion fourth quarter operating income target, since the Asia softness caveat defines the near-term ceiling. So I'm averaging down with cash-secured puts. Bottom line, this print earns a B from me. The experiences flywheel and streaming margin expansion are doing exactly what the bull case needed them to do, and the raised buyback plus multi-year guidance is a real vote of confidence from management. The sports miss and Asia softness keep this from being a perfect print, but the underlying trajectory is intact. Thanks for watching, and I'll see you on the next one.